Hi, good evening, everyone. Thank you for joining us today on Endowus Live. Today we have a very esteemed guest with us today. So it's Kelvin from Kelvin Learns Investing. So
Hi
Kelvin, why not you
guys.
just make an introduction?
Oh, okay. Hi guys. Welcome to the channel. If you haven't subscribed to me, subscribe to me.
So it's a pretty interesting collaboration that we have this time around. So we are both live on the Endowus YouTube channel as well as on the Kelvin Learns Investing YouTube channel, right? So for those of you who are already on Endowus Live, please go head over to the Kelvin Learns Investing YouTube channel and like and subscribe. And similarly, for those of you who are already on the Kelvin Learns Investing channel, please if you like our content, please like and subscribe to Endowus YouTube channel. Yeah. So very interesting conversations that we are going to have today on funds and stock picking, investing for beginners. Right. Okay, I'm just going to go straight into the presentation today. Just a disclaimer. I just want to share that the information and materials shared today is really for educational and informational purpose only. So please do not assume or feel that the information that we share are like financial advice given to you, because end of the day we don't know your individual financial circumstances, and it's hard for us to really give you we are just speaking in general. So yeah, just treat it as educational and informational purpose only. Okay, so we are trying to make this as interactive and helpful as possible for the guests, for you today. So please leave your questions on Slido. We are keeping a check on YouTube chat as well. Say hello, good evening, whatever, on YouTube chat. But if you have questions, please go on to Slido. You are able to upvote your favorite questions. You're also able to participate in the polls. So yep, let's get on to the first poll, right? Really want to understand the guests that we have today on with us, both from Endowus as well as Kelvin Learns Investing. What kind of investor are you, right? Because today's title is about stock picking as well as funds investing. So, which category do you see yourself? Are you largely a stock picker? 50-50 between like choosing funds as well as stock picking, largely a fund investor, or are you, someone who is largely a passive fund investor? So, Kelvin, where do you see yourself in this scale?
I think I'm a stock picker. Um, I don't really go for funds, but I do know people who are not that experienced in investing. They'll prefer to go for funds because it's managed for them, right? So yeah, it depends on your experience and your risk tolerance, lah.
Yeah. And maybe just a bit of context for those people who are not so familiar with you on Endowus, from Endowus. How is your investment experience like?
My investing experience so right at the start I was gambling my money away or by
Mm,
doing day trading. So I lost a bit of money, not a bit I lost quite a lot of money. Then after that I moved on to dividend investing because it was somehow safer. Then after that I went on to index fund investing, and recently I went on to growth investing like Tesla and even crypto investing lah. So I did put some money in robo advisor, but it's not a huge amount. It's mainly to see how well the funds can perform. So right now that's my portfolio lah.
Oh, okay, cool. I guess that's very interesting because I'm on the other end of the spectrum. So, for example, for me, I started just like you. I started off stock picking. I actually started off with dividend investing because I think
Do
back
you lose
10.
money?
No, actually, I made a fair bit of money. So I was investing in REITs in 2010 onwards, and I guess the REITs were doing really, really well. Things like Capital Data Center REIT later on. So some the REITs did well back then. But I feel that, it's a bit arbitrary. Because I was from NUS Business School, learning about finance, and whatever I have, the analysis that I've done with the stock picks, it feels very arbitrary. The analysis made as well as the results that I see in terms of the stock returns don't always make sense, right? So a company which I analyze should do well, in the end may not do well. And those companies that I don't really analyze and I just make a gamble, it eventually may give very good returns. So I felt that it's not very scientific, right? So eventually, I decided to focus more on my career, focus more on other aspects of life. That's why I treat investing more as a means to an end rather than something that I derive pleasure in. So now
Yeah.
I'm really more of like a fund investor, and to that extent, I prefer passive funds.
Mm.
Yeah. Okay, cool. Then I guess there's a lot of replies from the audience, and it's like, oh, 50% of them are actually stock picker. So yeah, there's going to be a very interesting conversation that you have today. So yeah, let's maybe move on to the
Okay.
slides. Yeah. Okay, so I guess when it comes to stock picking, based on my own experience, there is a lot. The main idea that they want to achieve, right, is to buy, look at stock investing from a few angle, right. Firstly, you assume that the markets are inefficient, right. What you see is that by analyzing companies or the markets and financial statements, you'll be able to identify mispricing within the market. Then eventually you will be able to choose the companies that are either too cheap, or and when the companies that you own are already overpriced, then you'll be able to sell it, right. So this is uh, how you identify mispricing, and then you try to make a higher return from it, right. And of course, along the way, what you try to attain is to buy great companies cheap, because sometimes the stock market fluctuates very randomly sometimes, right. And you will try to set a target price for you to to invest in the company, or set a target price for you to sell when it reaches a certain target price, right. And I guess another thing that people tend to do is also to try to buy companies that they are familiar with. So that's what Warren Buffett normally advocate, right? So the more you understand of a business, the more likely you are going to invest. It's better for you to invest in it, and then more likely that you hold on and stay properly invested, right? And some of the common strategies that are being employed by investors is that they try to look at it from a fundamental analysis perspective, right? Which I just now talked briefly about, right? You look at things like current and historical P/E ratio of a company, how dividend payouts have increased or improved over a period of time, price to book ratio, especially if you were to invest in something like a REIT, right? Or even doing certain level of like financial modeling when there's like a big M&A transaction going on, right? So these are the approach to fundamental analysis, and the challenge and or the limitation to that is that it's not so straightforward, right? Because different industries have different ways of looking at things like P/E ratio or even dividend payouts. Uh, there could be a very large scale macroeconomic change, right? So just as an example, you see that the S&P 500 PE ratio of it has been increasing over the past 10, 20 years, right? Is the market overvalued because of that? I don't have an answer to it. But if I were to sit out of the market because of my perception of market being overpriced, then it's going to cost me a lot, because the S&P 500 again hit all-time highs, right? So some of this fundamental analysis, it's not so straightforward because of the constraints that we have. Right. When it comes to technical analysis, the limitations are even more, right? Because it's really easy to not see very random returns. And for technical analysis strategies, these strategies are unlikely to last over the long term because of things like high frequency trading, right? So it's not something that is very sustainable based on research, and it's more often than not a bit of more of like a superstition when it comes to investing, rather than something that can be very systematically employed to give long-term returns. Right, I think nowadays there's a lot of meme stock investing. Right, if you look at follow threads like Reddit Wall Street Bets, or to if you were to follow some other hardware zone forums, people tend to have something that they want to invest based on market interest, right? And I guess the idea is very simple. You try to buy a company that's undervalued, and you sell it when it's overvalued. But when it comes to this kind of like forum-based, very sentiments-driven type of investing, it's really very difficult for you to determine whether the price that you are getting in or out is high or low, right? Because it's so driven by the market spirits. Yeah. So Kelvin, what do you think? What's your own experience about around stock picking?
So there are the pros and cons of stock investing lah. So the pros is obviously if you go and buy one single stock and it's easier to get a higher return. Like someone in the comments said that Chicken Genius 10x on just Tesla, right? So that's the pros. But obviously, if you can go up 10x, obviously it can go down very quickly. So if you are blah blah and you don't know what you are doing, then the risk is much higher compared to investing in funds. On the other hand, if you are investing in single stocks, then the fees are very low lah, when compared to robo-advisor or fund investing. Because let's say if you use interactive brokers, your fee is like 30 cents to $1. Or if you use Tiger Brokers or Momo, it's only like $2. And you get a free gift on top of it if you sign up using a referral link. Then on the other hand, if you invest using ETF, the fees are generally lower, like 0.5%. Or if you need someone to manage your fund for you, like robo-advisor, active funds like RK ETF, then the fees can be up to 1% or even more. So these are the pros and cons of investing in single stocks, I would say.
Yeah, maybe just to add on to that, I think investing in the part about fees is actually a lot more complicated, right? Because I guess when you buy single stocks, you pay a one-off transaction fee, right? And then if you were to buy and hold, actually the cost of that one-off transaction fee could be very low across your entire investment period, right? But when you invest in a fund or when you invest in funds through robo advisors, then there is always that recurring charge across a period of time. So yeah, so that's some of the nuances behind this. But one more point to add, I want to add is that I guess when you invest through a platform like a brokerage, they have the user experience or the interface is actually trying to encourage you to trade more, right? So there's always like a top 10 winners, top 10 losers. It's always either a sea of green or a sea of red, right? So there's that inclination or that urge to ask you to do something with the money, right? And I guess that's where the risk of you over trading or over tinkering with your portfolio happens. And I guess I will share a bit more on that later on. Yeah. Okay, let's move on. Your investment experience with Tesla, if you can share something about that.
So viewers of my channel will know that a huge part of my portfolio is in Tesla. I think like after the recent run up, it's already like 80% of my portfolio. Even though I don't intend it to be so high, it's like that. So I started investing in Tesla around March 2020. And the time I wasn't familiar in the stock. I bought it only because Chicken Genius said that he likes the stock. So if he likes the stock, then I like the stock. Then obviously it's a bad idea to just follow blindly. So when it dipped around March, I paper-handed and sold. Looking back, it was a very bad decision. But over time, right, over a few months, the more I researched, the more videos I made, I realized that Tesla has the potential to become a good company. So the bigger conviction that I had, the more money that I pour into Tesla. But I'm not telling you to invest in Tesla. I'm just telling you my own experience. Then what I realized was that if you are a noob investor like me, and you are new to investing, you actually don't really have to go in deep into the financials. Like you don't have to see how much they are earning specifically, or what are the debt levels specifically. You only need to know like they are earning more money every year. Their debt level is consistent. Their cash flow is increasing. These are the things to take note of when you are looking in the financials of the company lah. Just the basic stuff lah. Don't have to go too advanced into it. Because I don't go look at all those stuff lah. As for research, right, you can go look at the blogs like Sidley. They have good articles on individual stocks. I think, quite frequent lah. Then YouTube, a lot of YouTubers talk about stocks, right? But the thing is, you don't just go and look at the YouTuber who are allocating the stock. You also have to look at YouTubers who are against the stock. That way, you will get a more balanced view lah. Whether some say they like Tesla, some say they hate Tesla. So you take the views from both sides, and you make your own informed decision lah. So TLD don't follow blindly. Do your own research.
Yeah, on this note, I really appreciate, when Kelvin says something about, like, try to get an opposing view of things, because I think, for us, one of the bias that we exhibit as investors, one of the bias that we exhibit is confirmation bias, right? So we tend to search for information that confirm whatever our hypothesis is. So, for example, if I have a feeling that, okay, Tesla is a better investment, then I will go and go to websites that that confirms my bias. So, for example, parts of YouTube channels like maybe Chicken Genius, where he's obviously a very big Tesla fan, right? So there is that inclination for us to confirm our bias, and maybe hang out with friends who have the same investment approach as us. So it's good to have a slightly more cautious or even cynical view of investing, and always question yourself, like, whether this is the best way to invest.
Yeah.
Yeah. So what about
Okay.
your own experience around, like, mistakes about investing? Yeah.
So these kind of mistakes I actually made not so recently already. It's more of a beginner's mistake lah, that I would say. So right at the start, when I see a stock, I would just think the stock is just the name and the price, like Sheng Shi is this amount, Tesla is this amount. Then we will think like, wow, Tesla $1,000, very expensive. But actually, there's a lot more stuff behind just the numbers and the name lah. Like there's a real company behind it. There are people working for the company. There are the whole production, everything lah. So when you are buying a stock, right, know that you are investing in a company, not just buy low sell high lah. So then try not to follow blindly. This one I mentioned earlier. As for buying low, selling high, all of us are not Fakor lah, Fakor the gambler lah. So our strategy is obviously not to buy low and sell high, because if you see all the top billionaires, all the top investors, they don't really do that kind of thing lah, buy low, sell high. Most of them just follow this simple strategy: buy and hold. Just keep buying and holding, and only sell if you need the money or if you found a better investing opportunity lah. Then the fourth mistake is selling winners. So let's say if you see Tesla $800, if 2 weeks ago you see it goes up to $900 and you sold, wow, you gain $100, but then it went to 1,002. This means that you missed out on a lot of gains. But this is just a short term. If you see over the long term, even like Cathy Woods, Chicken Genius, who are bulls of Tesla, they give it like 3,000 over returns. $3,000, you reach $3,000 by 2025, according to them lah. So if you were to trust them, it's like 3x of the current price, and compared to your $200 is nothing. So basically, just if you have a winner, just hold it, don't sell. Then if you really want to sell, right, I would suggest look into options selling options, because you can generate a consistent income out of them. But this is more for the advanced investors lah. But for basic investors like me lah, just buy and hold lah. That's all.
Yeah, maybe just to clarify, Kelvin, like, and I guess that's also alluding to one of the questions that have been asked by the audience. Do you actually derive pleasure when it comes to, like, picking picking the right companies, or the right companies to invest in, or you are more concerned about getting the returns? So, for example, if your experience on very good returns is funds, for example, then would you just stick to funds investing?
Mm, I think for me, I'm basically a noob in investing lah. So I don't really pick funds. I mean, I don't really choose any new investments. I'll just stick to whatever I know. Like let's say if I'm only know Tesla, then I'll just stick to Tesla all day long until I see someone else mention something new. Then I will only try to research, uh, and but it's not an overnight thing. I will research over a few weeks, over a few months. Then I will only start to think about investing into that company. But so far, this hasn't happened to me yet because I don't really like to. I don't really like new stuff lah. I'll just stick to whatever I know. Yeah.
Okay, cool, cool.
Oh, by the way, I just want to point out one strategy, right, about buying and holding. This is what the billionaires use. A while ago, I saw this video. It's about it's by Andre Jig lah, if you know. He talks about this strategy called buy, borrow, and die. Basically, that's how billionaires avoid taxes. So if let's say we don't have that problem in Singapore because if we sell Tesla, we got $1 million. The IRS won't come and say, hey, you owe me 20-30%. But in Singapore, but in US, right, if you sell, right, their IRS will come after them and like, oh, you have to pay your gains. So you're basically losing like 20 over percent on whatever gains that you have. So for the billionaires, right, they don't sell their assets. Instead, they borrow against their assets. Like let's say I use margin, I use a collateral backed loan. Uh, that way, the interest is only like 1 to 2% or even lower than that. So they use it to buy whatever they want, to finance their lifestyle, to buy new stocks. Then, because they don't touch their assets, right? The assets will keep growing. And the best thing is they don't have to pay taxes by not selling. They only have to pay like 1-2% interest on their loans, and they just have to pay back the loans. So that's how they avoid paying taxes. Then in the final step, right, they die. And then they pass on the entire asset over to their next of kin. So that's how generational wealth is created buy, borrow, and die. So yeah, interesting stuff.
Yeah, interesting. I guess really that I mean I'll share a bit more on this later on. I guess the point is, cash is trash. I think that's the
Yeah,
first thing that I want to share, right? Because even okay, maybe when it comes to margin investing, or margin trading, it's a bit something that's too advanced for this beginner session, right? But or even for people like myself, I'm quite uncomfortable with margin investing, right? But in general, I guess if you want to really make a meaningful difference in your wealth accumulation journey, you have to invest, and you have to invest in a meaningful way, right? Not just like, hey, I take $1,000, $2,000 to go and put it in the most speculative, the highest risk investment, and hope to get 2x, 10x returns, but really to
yeah,
invest as more of your wealth in a meaningful way, so that there's more money that is growing and compounding over a longer period of time.
yeah. So
Yeah,
so it must have a purpose. Like let's say if you go to gym, you don't just go for 1 or 2 day, right? Your muscle will never be buff lah. You will only be sore. So if you really want to build muscle, you have to do it consistently, right? And do it 1 or 2 hours every week or something like that. So this is the same for investing lah. You don't just pour in $1,000 and be done with it. You won't get rich or whatever lah. So yeah,
yeah, cool. I think that's a very good point. Like, it's like investing is like going on a diet. Though it's not, you can't see a result in 1 or 2 days.
yeah,
Okay, yeah, and I guess maybe let me share my own take on investing in a more active manner through stock picking, right? So I guess one of the major arguments that stock pickers would like to share, especially for the just maybe to also share some perspective to that to, the, to be a contrarian for that 51% who says that they do mainly stock picking, that actually Warren Buffett is not such a good role model to emulate, and we may not be able to emulate him so easily as retail investors, right? So one of the main reason why Berkshire Hathaway is able to get higher returns than the S&P 500 previously is that he's able to access higher returns through higher borrowings, and it's not purely because he's able to outperform the market through his the kind of active investment decision that he makes, right? So this is a study that's made by the CFA Institute, and they realized that if you were to look at how Berkshire Hathaway invested, a very big part of how he's able to generate higher returns is because they are an insurance company and they are able to, they are a triple A company, right? So they're able to borrow very, very cheaply and buy a lot more assets than what they have in their books, right? So it's much easier for them to get higher returns from there, right? So that's one thing. And the other thing is that he has an investment strategy. He doesn't really just pick Coca-Cola or IBM or whatever companies and get better returns just because of his specific stock picks, right? What the CFA Institute realized is that he has, if you were to adjust for the investment strategy that he has, which is to focus on value quality stocks, actually he doesn't really have any outperformance, right? So it's more of like some people will even say that it's some form of factor investing where you are buying, value companies, you are buying more companies with better cash flow, and this is not really a stock pick. This is more like an investment approach, right? And I guess the last point is really pretty unfortunate. So recently, he has been underperforming the S&P 500, and I guess that's also very much because of his his experience around investing in companies that he's familiar with, right? So he wasn't investing in tech companies like Google, Amazon, Apple until more recently. And as all of us know, the tech companies, the tech sector has grown tremendously in terms of the market cap for the S&P 500 across recent years, right? So he has been doing very poorly relative to the S&P 500 recently. And what he has also been doing is that he has been doing share buyback, and normally what share buyback implies is that they realize is that they are unable to deploy their cash effectively to get higher returns, so they rather just invest in their own company, and it's a sign that basically the Warren Buffett team has run out of investment ideas, right? So these are some examples why Warren Buffett is probably not as great as we think he is, even though I'm sure he has his many of his quotes and investing lessons have given us some guidance on how we should be looking at investing. So on this, I just want to share a chart on how Warren Buffett, the Berkshire Hathaway has performed against the S&P 500. Right, you can see that the lighter blue or the gray chart is actually the returns of the S&P 500, and you can see that recently, the S&P 500 has been doing better. So just some figures for reference, and yeah, so we are going to share more about investing in funds now. And I think Kelvin will share more about his perspective.
So there are two kinds of funds, right? Active funds, passive funds. So let's say like S&P 500 is like a passive fund. UPK ETF is like an active fund, right? There's someone behind actively managing the funds. So there are obviously pros and cons to each of them lah. So for active funds, there's a manager managing the funds. So it depends on how good is that manager. Like just now you showed that Warren Buffett. I'm sure sometimes he will outperform, sometimes he will underperform. But if he doesn't keep up to date with the latest trend, then it's hard to outperform the market, I would say. Then there was some study that found that 91% of active funds actually underperform the S&P 500. This is on top of all their access to all the data, all their analysts and stuff. And on top of that, they are charging a higher fee compared to a passive fund. So if you ever choose active funds, right, it's very important to choose a good fund manager, not just look at the fund itself. You have to see who is behind the fund. And this part is actually quite hard to do, I think. Then on the other hand, there's passive funds. So it's basically just tracking the market. If the market goes down, then the fund will go down. If the market goes up, then the fund will go up. For example, it's like STI ETF or like S&P 500 or like technology ETF like SSLK. Then because this thing is a passive fund, the fee is very, very low. Like it can be for Vanguard funds is like lesser than 0.1%. For other kind of funds is like 0.5%. So even Warren Buffett himself recommends to just invest in passive funds. So he gave his trustee, he told them that if I ever pass away, just use my inheritance and invest all of them in S&P 500. So that's how much he trusts passive funds lah. Yeah.
Yeah. On that note, I guess to Kelvin's point, it's really not easy to beat the market, right? And I think a lot of studies actually showed ascertain this, right, by Morningstar. And for example, when you look at a longer investment period of 5 years, actually only 26% of the funds manage to beat the market, right, and remain in the top quartile. And over a longer period of time, only 14% of them manage to stay within the top quartile, right? So it's like it's almost like a dice roll to that extent. And after some time, you realize that most of these fund managers are not able to outperform because of the fees that they are charging, which is what Kelvin was sharing about, right? So you can imagine that for fund managers to be able to actively invest, they will need to dedicate resources to uh, doing research and to trade in and out of the market, right? So that builds becomes a part of the total expense ratio of and the management fees of the fund, and then in the end will eats into your return over a longer period of time. Yeah. So, but then maybe just to also share a counter argument for active fund management, right? So I think it's very very easy to really just lump everything and make a point that okay, passive equals to good, active equals to bad, right? It's very easy to say that, but I guess this is evolving. The financial markets are maturing and evolving over a long period of time, right? So if, for example, if you were to make a statement in 1900, back in the days where yeah, they are still using steam engine, for example, right? The circumstances are a lot more different, and the index it may be easy for fund managers to consistently beat the index at that point of time, right? But the financial markets are actually evolving all the time, and if you were to look at for example, the U.S. Broad markets indices, for example, the U.S. large blend, U.S. mid blend, and small blend. All of these funds, all of these indices, it's very difficult for the active funds to consistently beat their respective index, right? So, for example, only 44.8% of the U.S. large cap companies, uh, U.S. large cap active funds can beat the market in a 1 year time frame, right? So it's against a dice flip of a coin. Around 45% managed to beat, right? But if you were to spread it out into 5 years, only 26% of the U.S. Large cap active funds would beat the market, beat the index, right? So it's not easy for developed markets, for fund managers to do well for developed markets, right? But if you look at something like, for example, the US real estate, or you to look at the global real estate, right? The chances of active fund managers beating the index is actually a lot higher, right? So and it's even more so for things like corporate bond funds or even high yield bond funds or intermediate core bond funds, right? So it's actually a more nuanced answer, right? And generally speaking, you know, for for sectors like emerging markets, fixed income, it's possible for specific for active fund managers to do better and to do better consistently, right? And very developed markets like the US market, something that's tracking or benchmarking it against the MSCI All Country World Index, those could be, those should, probably be invested in passive funds. So that's what I want to say. But I think something to take note of is always to invest in cost efficient funds, because everything is constant. Cost is always a constant when it comes to investing. Okay, so just to share a bit of how we look at fund selection at Endowus, we really care about things that can be identified when it comes to fund selection, right? And our investment office work really hard to really bring in the best in class funds, the lowest cost and most appropriate product for our clients to invest in. Right. So what happens is that we come up with a curated fund list rather than being a supermarket of funds. Right. So we do the fund selection for you. There are the best funds for the different investment strategies out there, and we make sure that we have Sing dollar denominated tax efficient options available for our clients. And that is how we are different from other platforms that are out there in the market. Right, so let me just very quickly share with you this investment fund list. I'll put the link of this within the YouTube comment. You can just play around with it. It's actually quite different from the usual fund platform. Right, so for example, you can see that there's a lot of information out there. And let's say you have a very specific investment strategy. So we talk about for example, Kelvin. I know Kelvin suddenly has an interest in emerging markets, right? So he wanted to choose an emerging market fund. He's happy to take higher risk for it, right? And we would be able to help him come up with a list of funds that are, appropriate for him. So, and this will allow him to this we are able to help him select a few different funds for him to compare against each other, right? So if you were to go there, you'll be able to see these four funds placed side by side, and then you get a lot more information on how these funds are being invested in terms of like their top 5 holdings, their historical performance, based on year to date 2020 returns, 2019, 2018, risk return matrix, how they are in terms of like the different risk matrix as well, the dividends that are being paid out, if any, as well as most importantly, costs, right? So Singaporeans, we care all about costs, fees. So these are the kind of breakdown that we provide for you. And I guess there's this question on by Harvey is that seems like most of the fund in the platform are actively managed fund. Actually, we do have a lot of passive funds available, and maybe because of how Endowus is being portrayed and marketed, actually most of our clients invest in more passive funds than active funds, right? So that's just something that I want to share, and we have a lot of passive funds from managers or passive or systematic funds like Dimensional, right? The LGI Infinity series, and whatnot, right? So I would just maybe encourage you to take a look at how we this platform. There's a lot of things that you can play around with, and you will be able to probably get something that is aligned to what you want. So you can see there's this passive selection. So let me just play around. Maybe just remove away this down selection criteria. So now we have passive, right? You can see that there's this even sustainable index funds, right? The S&P 500, global stock index fund. So there's quite a few options available, and the terms passive. I would say that Dimensional is a lot more passive than active. So that's another 6 or 7 funds at least. Okay, let me go back to the slide. Just a moment. Okay, how do you choose the right funds for yourself? I think most importantly is really to understand what you want in terms of your investment strategy, right? So the type of exposure that you want to get, right? So if for example you want to invest in China tech because you think that China tech technology will do very well, then you would choose an appropriate benchmark for it or an index that is trying to beat. Uh, then you also have to understand your investment horizon, right? Because you know something like China tech or maybe even tech in general will not be able to give you very good give you more consistent return over a short investment period like 6 months or a year, right? So these are some considerations of your own personal finances as well as your own exposure that you want to get before you get started on investing. And then the next thing you want to look out for is whether to do it passively or actively, right? So if you were to choose a index tracking fund or a passive fund, then you need to see how well it's tracking the index in terms of the tracking error, whether TER is lowest, and need to look at things like whether there's if you are buying a ETF, then whether there's sufficient liquidity for the fund, whether the fund is domiciled in a tax efficient manner, right? And same for active investing, right? When it comes to active investing, then you need to have the confidence that the fund manager is able to uh, outperform. Has he or she outperformed before, and would he or she be able to outperform in the future, right? I guess a lot of people they look at ARK investing and they have that assumption that okay, they have gotten great returns in the past, and they should be able to do well in the future. But some of the actions that the team has made over the recent times have actually drawn some doubt about it, right? So it's not so straightforward, and yeah, it's quite important to analyze and have an understanding of the funds before you uh, really start investing in it. And I guess yeah, when it comes to passive investing, right? I think maybe for some of the stock pickers out there, it seems like hey, just buy S&P 500, very easy for us to get that kind of market returns, right? But end of the day, it's not so. It's in practice, it's not so easy, right? If you will look at this figure provided by JP Morgan Asset Management in September 2021, the average investor between the period of 2001 to 2020, most of them actually just get 2.9% return compared to you know even a more measured portfolio of 40% equities, 60% bonds, 5.9%, right? People don't actually do as well as the market return, and a lot of it is because of some poor investment poor investment behavior. And I guess for beginner investors, it's very important to be very self-aware and mindful of these investment mistakes because they will really set you back. And it's not so much about whether you are a stock picker or whether you are a fund investor, but more so of how you react to market volatility and your own fear of losing money. Yeah, so on this note, right, I just want to really take a step back and address some of the concerns that we may have when it comes to, uh, you know, investing well, right? I think largely speaking, Kelvin and I, we both agree on some of these challenges that we have when it comes to investing well for beginners, right? I guess learning to start to investing consistently. This is one of the challenges. Staying invested is also another challenge, right? Sometimes like what Kelvin said, you paper hands, you see the market tank, you want to get out of the market, right? And choosing the right investments is also very difficult, right? Over at the YouTube chat, I see that there's a lot of discussion around whether Tesla is overhyped or not, right? I guess that it's sometimes it get very like investing is like a religion, right? Sometimes people get very strong beliefs, and for beginners it can be very intimidating given the very disparate views of the markets that more seasoned investors may have, right? And then I think the last point is always something that even I myself sometimes face, right? Timing the markets, right? You try to buy low, sell high. You try to get out of the market when things seems to be going very badly. So these are all challenges that we face, right? And you can see, we always been fed by news. We are fed news by the media agencies on how markets are at an all-time high, how there's always like uncertainty around the Fed rates and whatnot, right? And this will eventually make us, behave poorly as investors, right? So for people who have not even started, you would not have invested or would not have started investing. For people who are, choosing investments, you might be underperforming the market because you just go in and out very quickly, right? So these are some of the things that we face as a challenge as an investor, and we have to be very mindful that whatever investment method or investment platform that we use, are they helping us with the right investment behavior, or are they not, right? So on this point, it's not difficult for us to be able to do well in the markets. It's simple, but it's not easy to execute, right? So you can imagine for the worst market timer, right? So for someone who actually invests in the market at all-time highs, he would still be able to do very well even if he were to uh, invest at all-time highs. But he just have to hold on to his investment over a long period of time, and you get a very high return, right? So of course, there's volatility involved, and he would have to really clench his teeth and get past those difficult time. But the long-term return is actually very decent, right? So, for example, someone who invested in during the oil crisis in 1973, bought at the high during the Black Monday in the 1980s, bought into the market just before the dot-com crash, just before the subprime mortgage crisis, just before COVID. If you were to buy and hold throughout this entire period, right? Stay invested, clench his teeth, there with the volatility, he would still be able to get 8.72% even as of end April 2021. Yeah, so this is something very incredible, right?
Yeah,
And
I just want to add on something.
yeah,
From around 2000 to around 2015, there's a something called the lost decade lah, where they don't get any returns if they just hold on for 20 years, around there, plus minus. So the trick is actually to not just buy and hold, but also to dollar cost average. So even if you buy at a high and you dollar cost average, by around, let's say if you start around 2000, year 2000, then it went down to 2008, it crashed around there. But if you just dollar cost average all the way down, you have sort of break even around 2005. So yeah, the trick is also to just invest consistently lor, and keep dumping money in, even if the market goes down, just keep buying in the stock that you want, and you recover much faster compared to everyone else.
yeah.
Yeah.
And I guess that point is always there's always a question around, should you lump sum invest or should you dollar cost average, right? And I guess for
When Ga actually did a study on this, should you lump sum or dollar cost average? What they found was that actually lump sum gave a higher return compared to dollar cost average, but the difference in return is only like 1 to 2%. So personally, I use dollar cost average, even though it was proven that lump sum gives a high return, because dollar cost average gives me comfort, knowing that I have money to invest if ever the market goes down. So actually, but then on the other side, if the market goes up, then I'll be missing out on the gains. But whichever strategy you choose is fine, as long as you can sleep well at night. I would say.
Yeah, I think most importantly is just to make sure that you account for your behavioral issues and don't
Yeah.
have a knee-jerk reaction to investing, right? I guess just now when Kelvin was sharing about the lost decade, it's around it's for the US S&P 500, and I guess that's where it's a good idea to invest even more broadly than just the S&P 500. Buy the equivalent of the world index, buy the equivalent of the MSCI All Country World Index, right? So you don't just rely very heavily on the US stock market, but you also buy into Europe, Japan, China, even smaller markets like Hong Kong and Singapore. Yeah, And this is, I guess, the something that to end off with, right? Time in market is actually a lot more important than timing the market, right? And it's very important for us to have more in our investments than having more in cash, because timing the market is very difficult, and it's really, I think it's very difficult to do it well once. It's even more difficult to do it consistently well across 20 or 30 years, right? So I guess to the point on this is that if you were to invest in if you were to just have 100% in your investments, right, you just need to have a 7.2% annualized return for your money to double every time, right? But if you to hold on to too much cash, let's say for example 80% cash, for you to double your investment, you need to get a 25.9% annualized return for you to double your cash in 10 years, right? It's a lot more difficult to do that consistently, right? I'm not very sure whether it's possible for you to identify a single stock that's able to give you 35.9% across
Tesla.
10 years. Yeah, but that's on hindsight, right?
Yeah,
If
hindsight.
I on hindsight, yeah.
Yeah.
So I mean I'm I wish that I'm the person that is able to invest in Tesla, you know, 10 years ago. I wish that I invested in Apple back when I was in junior college, right? But it's those are all based on hindsight, and
Yeah.
yeah, it's not easy to execute on it. And to identify the next Tesla or Apple or Google for that matter. Yeah. So I guess just to conclude today's session, right? It's most important for you to really know what's your investment goal and what you want to achieve in investing, right? Because it's very easy for us to be led astray by what's out there in the market, right? It's very important for you to also get your priorities right, right? What do you want to achieve with your investment experience? And then lastly, it's you also have to be very mindful that we cannot really even for experts, it's very hard for them to fully understand the market and to outsmart the market beyond understanding the market, right? And it's more important for us to be very self-aware how our investment behaviors is like, and try to improve on it or correct it. It's just like exercising, right? We take steps and improve on it so that we invest longer term, we stick to the right investment approaches, and we'll be able to uh, do well for ourselves over a longer period of time. Yeah, so I think there's this quote by Benjamin Graham. He is the mentor or the teacher of Warren Buffett, right? And then I guess this quote is really helpful for us, even at whatever stage of our investment experience. Sometimes I also look at this quote and I just reflect on my own actions, and I think it's really helpful, right? So it says the investor's chief problem and his worst enemy is likely to be himself, because in the end, how your investment behave is much less important than how you behave. So yeah, this is just something for the viewers to take away with.
Or in short, don't be a donkey.
Don't be a
Donkey.
donkey. Okay,
Yeah.
yeah. Okay, I think that's the end of today's session. Guys, please feel free to ask your questions on Slido. Uh, okay, I guess there's this question just asked by anonymous. How old is Kelvin? He looks young. Kelvin, do you want to answer just something more
34.
light-hearted?
I'm
Sorry, how?
34 now. 34.
Yeah, 34 now.
Yeah.
Okay, I'm not very sure whether you share that in any of your videos. Okay, I think there's some other questions. So guys, please look through the YouTube chat, or else you can also look at the YouTube description for the Slido link. Ask any questions that you have for Kelvin, Gogo, or for myself. Okay, I see that there's a question that's specifically about Endowus. Would Endowus start adding funds? Um, just a moment, yeah. Let me change the format. Would Endowus start adding funds from iShares, Spider, Vanguard, Schwab into your list of investment fund? We actually are trying to, in the process of adding in more funds. So you can see the Fundsmart list of funds actually have been growing over a period of time since we started it, since we created the Fundsmart platform in April 2020. So yeah, there's been a lot of improvements since then. We will try do our best to include the most appropriate funds available on the platform. Yeah. Okay, and the argument for passive investing works for US dollar S&P 500. Does it work for Sing dollar exposed to currency risk, withholding taxes even for Ireland listed funds? Okay, so this one is a more high level question, and maybe let me just take a step back and share the concerns of the viewer who's asking the question first, so that we all understand where it's coming from before we talk about why is what's our take on it. Okay, so when you invest in something more global like the S&P 500, there is always perceived currency risk, right? Because we are Singapore investors, we spend we go and eat cai peng at hawker center, right? And those are in Sing dollars. A lot of our spendings are in local currency, right? And there is a perceived risk that if we were to invest in foreign currency, then what if one day Sing dollar appreciate a lot more than USD? Right? Would that lead to our real investment value dropping a lot more than the gains that we have from the S&P 500? Right. So that's the perceived currency risk that we have when it comes to investing. And I would say, generally that's true if you were to be, say, for example, in being based in a country like China where there's a lot of domestic, uh, creation of economic goods and services, right? China itself is a very self-contained economy, right? The food that you eat, the services you get is all produced within China. But for Singapore, actually, if you were to see the type of services that we consume, we are using Netflix, we're using Spotify, a lot of the advertisements, Kelvin is on YouTube, right? So Google is generating a lot of ads revenues. So we are a very import driven economy, right? The vegetables that we eat for our cai peng is all coming from Malaysia. So there's not much currency risk if you were to invest globally because we are a very open economy. So investing in like a S&P 500, even a global index, is actually fairly safe for us, especially if you have a long investment horizon, right? And to your point on currency risk and on a shorter investment horizon, for a shorter investment horizon, it's even more important for us to invest in, like say, a currency hedge fixed income product, right? And that's what we do at Endowus, because over a short period of time, countries' monetary policy will change, the FX movement may change, and that will impact on your real investment return after taking into account forex costs. Right, so it's important to be FX hedge for short-term investment, and that's why you should get a Sing dollar hedge fixed income products, not fixed income products in US dollar as what a lot of other robo advisors are doing, right? And for longer investment horizon, it's actually okay for you to take some FX risk, and maybe later on you switch over to a safer FX hedge product for you to make sure that you don't get any FX exposure. So this is a very long-winded answer. I hope the viewers get it.
Yeah, that was the question. Is there a strategy to dollar cost average? I think it depends on whichever makes you sleep well at night. Like let's say for me, right? As you all know, if you follow my channel, I lost my job. So to me, right, I have to hoard some cash because I have a wife, I have a kid, I have to feed them. Otherwise, my wife will run away. So so I have to actually hoard more cash than usual. But let's say if I have a job, right, I wouldn't mind pouring to dollar cost average as fast as possible into the market so that I can use up all my cash. Because as long as my cash is not invested, the inflation is going to eat up like 1 to 2% of my cash every year, and I'm going to miss out on all the gains, all the potential gains So it depends depends on your circumstances. If you have a consistent cash flow coming in, according to some people, is they would recommend dollar cost average and use up all the money within maybe 2 to 4 months. But it depends on you. Yeah.
Maybe share the questions here. I guess my strategy towards dollar cost averaging or lump sum investing is that I generally just invest everything that I get net of expenses every month, right? So I'm always 100% into the market, right? And I guess this is also because how I observe some of my friends invest, right? It's very difficult for people to invest very consistently, and for example, if for a lot of us who are very good savers, we may save up, squirrel up $2,000 or $3,000 a month, but we just tell ourselves, hey, maybe I just invest $500 every month, right? And we just put in $500 every month, and then maybe later on when the market drop, then I put in the rest of the money, right? But the thing is that you realize that over a long period of time, 3 or 4 years into your career, you may have 100K sitting in your bank account, and it's very, very stressful for you to think of how to manage that 100K investment. Right. So that is just something to keep in mind when you ask this question on, like, should I dollar cost average or should I lump sum? I think the end goal is that you should try to get comfortable holding less cash, and try not to accumulate a lot more cash, more than whatever you need, as you invest, because you don't want to end up like having 100K, 200K, and you realize that, now the interest rate 0.05%, right? You can't really do anything about it. So that's just something to keep in mind. Okay, there's this question that's very, very upvoted, and I also want to ask Kelvin this, right? So Kelvin, your portfolio is now 80% Tesla. Any thoughts to rebalance to Endowus or any funds? Yeah, what are your thoughts on that?
Actually, I've been thinking about this question since like forever lah. About half a year ago, when I went to the Sydney's interview lah, I told everyone that I was thinking on rebalancing my Tesla, but I I didn't do so because I didn't manage to find any better investment. Maybe I wasn't looking hard enough lah. And from 70%, it went up to 80%. And I think as long as I am not able to find a better investment, I will try to, I will just keep dollar cost average into Tesla lah, because that's my highest conviction stock ma. As for rebalancing, right? Actually, I'm looking to dollar cost more into into crypto, into crypto, but I haven't really found what is the best investment to go into lah. So for now, I'm just dollar cost average into Tesla lor. Yeah.
Yeah, and maybe let me just share a different perspective on things. So when I listen to someone like Kelvin, and obviously I admire and I wish that I'm making a very high return on my investment, like what he's doing with Tesla and maybe potentially in the future cryptocurrency. That is something that I may go through, and some of you may go through, right? Hey, someone else is doubling his money every 6 months. Why shouldn't I be trying something like this? Something that I comfort myself with is that I don't really need to spend a lot of time managing my investments, because I'm investing in very diversified low cost funds that effectively is trying to replicate how the market or how the economy is doing, right? So it's a very, very simple approach, and it's very easy for me to sleep well at night investing almost all of my money. Right, and I guess for many investors, even if you're a young investor, it's a very good place to start, because you build that discipline of investing in a way that it's very consistent. So it's like getting it's more like having a good habit of exercising well and eating well. So if you can start off with that, and understand yourself better before going on to something more higher risk, then that could be a better way to manage your emotions and biases around investing. Yeah, just to share an alternative view.
Yeah, most important is you can sleep well at night lah. Um, I know a lot of people are very risk averse. They will say this thing that can go so high will drop so fast. If that's okay if you if you don't like to invest in Tesla, right, you just go for S&P 500, whichever makes you sleep well at night lah. Because yeah, that's the most important thing lah. You have to keep investing over 30, 40 years lah. If you can't sleep well at night, how are you going to keep living on your life, right? Yeah.
Okay, I'm just going to take one last question. Maybe Kelvin, you choose one last question, one last favorite question for yourself because we are running late already. I guess there's for the Endowus crowd, there's this question that is like on everyone's mind. Sheng Shi Endowus Cash. Thanks, Wei Wen, for the question. Endowus Cash Ultra is losing money. Will there be rebalancing? So yeah, we acknowledge and understand that there's a lot more volatility with Cashmart Ultra recently, and that's because of the China debt issue, right? So if you are following the news, you would realize that there's quite a few Chinese real estate companies that are facing debt stress because of whatever that's happening over a broader macroeconomic concerns. So there is that with that backdrop, the bond funds that we have with China exposure, they are doing poorer, right? And I think the way we should be looking at Cashmart Ultra is that you should be investing more than 3 months into it. And if you were to do anything to sell some of these riskier funds when they are doing poorer, and to shift it to something that's safer, then we are effectively realizing our losses, right? So I guess the answer to you will be to you know to really consider whether you are sticking to your initial investment horizon and investment time frame and risk appetite, right? If it's still within your investment appetite and horizon, you should hold on to that investment and only liquidate the investment as and when you need it. And that's also how we try to manage your money for you by taking a longer term, deliberate view about it rather than some taking a knee-jerk reaction and trying to scramble and change the portfolio when something bad happened.
Yeah,
Okay, so I just want.
it's buy low lah. It's buy low, sell high, not buy high, sell low, and confuse your enemies, right? And I want to I want to add on, right? Even if it goes down, the point of Cash Smart Ultra is to hold it for like a few months, like Sheng Shi say lah. If it goes down, right? If you don't need the money, don't go and sell it lah. Yeah, if you need the money, right? It's obviously the wrong portfolio to put your money in already. You should have choose the lower risk portfolio. That will be more appropriate law.
Yeah, and that's why we give people three choices, right? Rather
Yeah.
than one choices. And yeah, I guess it's a good experience. Hopefully, not a very painful experience for our clients to reflect upon. So sorry to hear that you have been experiencing losses and uneasy about it. But yeah, hopefully we will be better investors from this experience. Yeah. Your last question, Kelvin, from all of the questions that have been put up. Are you looking at Slido?
I have nothing to say.
Oh, okay.
Why you
Cool.
look like that?
That's not very nice. I think I also yeah.
Yeah.
Okay, I guess that's all for today's session. Thank you everyone for joining Kelvin and I. If you are from the Endowus channel, please check out Kelvin's channel. He has a lot of great content there. Yeah, do like and subscribe his channel. And if you're with the Kelvin channel, you are able to get a really different type of content with Endowus, right? So we have different fund management companies, partners, even personalities or thought leaders like the Work Salaryman, Sudan from Sydney, Timothy and Dinesh from Dollars and Cents, sharing personal finance tips and perspectives. So do check out our channel. We have a lot of great content. Thank you everyone. Have a great evening ahead. Bye-bye.
Bye.
Bye.